Hello everyone, I'm Asian Guy. Something unusual has been happening across global financial markets, and it's not showing up where most people are looking. It's not a sudden crash, it's not a headline panic, it's a quiet shift in behavior. Slow, persistent, and structural. Governments are issuing more debt than ever before. Yet the institutional mechanisms designed to manage, absorb, and legitimize that debt are no longer expanding at the same pace. Markets are still functioning. Payments are still clearing. Auctions are still being covered. But the quality of participation has changed. The reasons buyers are showing up have changed. And the way institutions respond to stress has begun to look defensive rather than confident. This matters far beyond bonds or balance sheets. It matters because debt is not just a financial instrument. It is a social contract. It relies on credibility, duration, and trust in institutions that promise stability over time. When debt grows faster than the institutions that support it, the system doesn't collapse overnight. It stretches, it distorts. It slowly reprices risk in ways that are difficult to see in real time. And when you look closely, you can already see signs that major institutions are adjusting their behavior quietly, methodically, and without explanation. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. Let me walk you through the numbers, but more importantly, the structure behind them. Global debt today is not just high by historical standards. It is historically misaligned. For most of the post-war era, rising debt was paired with expanding institutional capacity, stronger tax systems, growing populations, productivity gains, political legitimacy. Even when debt increased sharply, there was a credible framework for managing it over time. Growth absorbed leverage. Institutions evolved alongside complexity. That relationship has weakened. Over the past 2 decades, global debt has expanded faster than real economic capacity, faster than demographic support, and faster than institutional adaptability. Governments issue debt not primarily to invest in future productivity, but to stabilize present conditions. Corporations refinance rather than expand. Households rely on credit to maintain living standards rather than improve them. This is not a moral judgment. It is an observable shift in incentives. Look closely at sovereign bond markets. Yields still move. Curves still invert and steepen. But participation quality has changed. Long-term holders, pension funds, insurance companies, sovereign wealth funds are no longer natural absorbers at scale without explicit or implicit support. Central banks have stepped in not as temporary liquidity providers, but as structural participants. Balance sheets expanded not to smooth cycles, but to replace missing demand. Now notice what quietly changed. As central banks attempted to normalize policy, markets didn't respond with confidence. They responded with fragility. Small changes in rate expectations caused outsized volatility. Liquidity thinned. Price discovery became discontinuous. This pattern doesn't appear often. We've seen it before, but only during periods when institutional credibility is under strain. Debt markets are supposed to reflect long-term confidence. When they instead reflect short-term stabilization needs, something deeper is happening. The issue is not whether debt can be rolled over next quarter. It usually can. The issue is whether the system believes in the duration of the promise. And duration is an institutional concept, not a numerical one. Now let's talk about volume behavior and participation quality. In healthy markets, rising issuance is met with diversified demand, domestic institutions, foreign reserve managers, long-duration investors. When demand narrows, volume can still look strong, but it becomes concentrated. The same players show up repeatedly. Official sectors dominate. Price sensitivity increases. Volatility migrates from prices to liquidity. That's what we're seeing now. ETF flows provide another lens. Passive vehicles have absorbed enormous amounts of sovereign and corporate debt, but passive demand is conditional. It is not conviction-based. It is allocation-based. When flows reverse, there is no discretionary buffer. This matters because it shifts risk from informed holders to mechanical ones. The system becomes more efficient on the way up and more brittle under stress. But this is where it becomes important. Physical economic demand, the real economy that debt is supposed to support, is not accelerating in proportion. Infrastructure investment lags issuance. Productivity growth remains constrained. Energy transitions require capital, but returns are long-dated and politically sensitive. Defensive spending rises, but does not generate broad-based economic expansion. Debt is being issued into a system with limited absorptive growth. Supply-side rigidity compounds the problem. Governments cannot easily cut spending without political cost. Aging populations increase entitlement obligations. Tax bases are less elastic than models assume. Institutions respond by extending maturities, adjusting accounting assumptions, and redefining stability. These are rational responses, but they signal constraint. Look at currency relationships. Reserve currencies still dominate trade and finance, but confidence is no longer absolute. Diversification is slow and cautious, but persistent. Bilateral trade agreements reduce reliance on centralized settlement. Central banks accumulate reserves with different characteristics. This is not a rejection of the system. It is a hedging against institutional fatigue. Real yields tell a similar story. Nominal rates rise, but real credibility does not fully recover. Inflation expectations fluctuate not because of supply shocks alone, but because trust in policy transmission weakens. When policy tools are used repeatedly for stabilization, their signaling power diminishes. Markets listen, but they don't fully believe. We've seen this before, but only during long transitions. Late Roman fiscal debasement, interwar debt overhangs, post-imperial adjustments. In each case, the system functioned until it didn't in the same way. Not through collapse, but through redefinition. Contracts changed. Institutions adapted downward. Expectations reset. This is not about predicting crisis. It's about recognizing regime change. When global debt outgrows the institutions designed to manage it, markets do not panic. They adapt. They shorten horizons. They prioritize liquidity over return. They reward optionality. And they quietly signal that the old assumptions no longer hold. What matters now is not the next auction or the next rate decision. It's whether institutions can restore long-term credibility without relying on perpetual expansion. That question remains open. And the market behavior we're seeing suggests that the answer is not yet clear. And what we're really observing now is not stress in a single market, but fatigue across multiple layers of the system. And fatigue behaves differently than crisis. It doesn't announce itself. It accumulates quietly. Institutions continue to operate, but with narrower margins for error. Decision makers become more conservative, not because they see collapse ahead, but because they no longer trust the range of outcomes they're modeling. That shift in behavior is subtle, but it shows up everywhere once you know how to look for it. Inflation, for example, is often discussed as a problem of prices, but inflation is ultimately a problem of confidence. It reflects how much people trust institutions to preserve purchasing power over time. When that trust weakens, inflation becomes less about supply shocks and more about credibility. Central banks can raise rates, slow demand, and signal resolve. But if markets believe those tools are being used to buy time rather than restore balance, expectations don't fully reset. They fluctuate. They remain anchored only conditionally. Look closely at how inflation expectations behave now. They respond quickly to policy signals, but they also reverse just as quickly. That tells you something important. Markets are listening, but they're not convinced. Policy fatigue sets in when tools are deployed repeatedly without addressing structural causes. At that point, even effective actions lose signaling power. The issue isn't competence, it's constraint. Currency trust follows the same logic. Reserve currencies retain their dominance not because alternatives are strong, but because institutions behind them have historically been credible. Legal systems, deep markets, military and political backing. But credibility is cumulative. It depends on consistency over decades. When fiscal expansion becomes structurally embedded and monetary policy is repeatedly asked to offset it, markets begin to separate currency utility from currency trust. They still use it. They just don't hold it with the same confidence horizon. This is why diversification away from single currency exposure is slow but persistent. It's not ideological. It's not reactionary. It's institutional risk management. Central banks and sovereign funds are not abandoning the system. They're adjusting duration, composition, and correlation assumptions. They are behaving as if long-term stability is less certain than it once was. That alone should tell you something. Investor psychology adapts in parallel. During periods of expansion, investors seek return. During crises, they seek safety. But during slow institutional erosion, they seek flexibility. They shorten time horizons. They favor liquidity. They avoid concentration. This doesn't show up as panic selling. It shows up as undercommitment. Capital remains mobile, cautious, and quick to reprice narratives. Markets feel restless, even when prices are stable. This is why volatility increasingly appears in unexpected places. Not necessarily in headline indices, but in funding markets, currency basis swaps, repo conditions, and peripheral assets. Stress migrates to where institutional backstops are weakest. And each time that happens, authorities respond effectively enough to stabilize conditions, but not enough to rebuild confidence. The system learns that intervention is reliable, but resolution is not. Now zoom out. Debt itself is not inherently destabilizing. Debt becomes problematic when it loses its link to productive capacity and institutional legitimacy. When debt finances future growth, it strengthens the system. When it finances present stability at the expense of future flexibility, it weakens it. That distinction matters. Right now, a growing share of global debt exists to maintain existing structures rather than transform them. That is a sign of maturity, but also of limitation. Institutions face trade-offs that didn't exist at this scale before. Fiscal authorities must choose between consolidation and social stability. Monetary authorities must choose between credibility and financial fragility. Political systems must choose between long-term reform and short-term consensus. None of these choices are easy. All of them involve cost. Markets sense this, even if it's not explicitly stated. This is where historical parallels are useful, not as predictions, but as frameworks. Periods of high debt relative to institutional capacity tend to resolve through some combination of growth, inflation, restructuring, and redefinition of obligations, rarely through outright default in advanced economies, more often through gradual adjustment that changes the meaning of contracts over time. Terms shift, expectations reset, the system continues, but on different assumptions. We've seen this before, but only during long transitions, after major wars, during demographic reversals, at the end of dominant economic eras. In each case, the public narrative lagged reality. Markets adapted first, institutions followed, households adjusted last. The process was uneven, frustrating, and difficult to measure in real time. What's different now is the global synchronization. Debt expansion is not isolated, it's systemic. Institutional strain is not confined to one country, it's shared. That limits the ability to externalize adjustment. It also increases the importance of coordination, even as political cohesion weakens. This tension defines the current era. So, what does this behavior actually suggest? It suggests that markets are no longer pricing a return to the previous equilibrium. They are pricing an extended period of managed imbalance, a world where stability is maintained through intervention rather than self-correction, where risk is not eliminated but redistributed, where institutions remain functional but less flexible. This changes how capital behaves. Long-term commitments require higher confidence premiums. Short-term opportunities dominate. Optionality becomes valuable, not because collapse is imminent, but because outcomes are wider and less predictable. In that environment, traditional valuation anchors lose some relevance. Relative stability matters more than absolute return. It also changes how we interpret policy signals. Rate hikes, balance sheet adjustments, fiscal packages. These are no longer seen as decisive actions, but as iterative responses. Markets ask not, will this work, but how long does this buy? That shift in perception is critical. It reflects a loss of finality. Policy manages trajectories, not destinations. None of this implies inevitability. Institutions can adapt. Reforms can occur. Productivity can surprise to the upside. Demographics can be mitigated through policy and technology. But adaptation takes time, and during that time, markets remain cautious. Trust rebuilds slowly. Credibility is earned incrementally. The role of debt in the system is changing. It is no longer just a financing tool. It is a signaling mechanism. It reflects institutional confidence, political constraints, and social priorities. As debt grows, its meaning evolves. Markets read those signals, even when policymakers don't articulate them. This is why awareness matters. Not to trade it, not to fear it, but to understand it. Slow institutional failure doesn't look like failure. It looks like continuity with declining margins. It looks like systems that work, but require constant support. It looks like stability that depends on intervention rather than resilience. When global debt outgrows the institutions designed to manage it, the adjustment is not dramatic, it's procedural. It happens through accounting changes, policy frameworks, and behavioral shifts. The financial system remains intact, but its internal logic changes. Those who recognize that early don't panic. They recalibrate expectations. That's the core takeaway. This is not a story about imminent collapse. It's a story about transition, about how markets quietly change before the public notices, about how institutions signal constraint without saying it outright, about how debt, credibility, and trust interact over long periods. Understanding that interaction doesn't give you certainty, it gives you context. And, in periods like this, context matters more than conviction. Thanks for watching, subscribe, share this, and stay alert. Because what's happening right now matters more than most people realize.